The third lesson of the rich is mind your business. Might sound funny, but what does that mean? In essence, in the book, Rich Dad always focused on creating income producing assets, starting businesses, working on real estate deals with joint ventures. If he didn't have the money, he found people with money and did it together. Any salary or income he created, he would invest it in income producing assets or starting businesses, as I mentioned, or also investing in the markets to create more income and more capital to continue investing in other areas. So what this means is that if we are constantly salaried individuals, in the long-term perspective, it is very, very difficult to get out of the rat race because of consumption, because of exchanging our time for money. So in the end, the quicker you can create something as a side business or a side venture and work for yourself, the quicker you can mind your business, the faster you can create income producing assets and therefore get out of the rat race and financially free sooner. So the key points here are focus on the asset column and focus on income and loop that over and over. What does that mean? I showed it visually here. So what Robert Kiyosaki says in the book is the best advice he got for this key lesson is that the rich take any income that they then use to buy income producing assets and they never let this money come out. Once you put that $100,000 in a revenue property, for example, they will never remove that money out of that cycle. Why? Because that $100,000 that was used to purchase an income producing asset is always going to produce that income over time. So you can never let yourself take that money out. You must have the discipline to leave that money in and let it continue to create the fruits of your labor. So what he then says is the income from the income producing assets can pay for your luxuries or your expenses. So he gives an example, and this is a bit of an extreme example in the situation because he was far along the process, but he said, my wife wanted a Mercedes. I could not afford a Mercedes. And then when I eventually could afford a Mercedes, I did not want to buy a Mercedes with, for example, the $50,000 that he wanted to use. So in essence, what he did, in the contrary to spending that $50,000 on directly an expense, so income directly to expense, money gone. You just bought a liability, not an asset, as I mentioned earlier. He took that money, invested it in an income producing asset, which over time grew, and he was able to take that income from that asset and pay the monthly payment on that Mercedes. So what he's doing is using the cash payment or the fruits of his labor to pay for that luxury, but the asset and the money used to buy that asset are always there and will always continue to produce the fruit. Picture planting a tree, the tree grows, produces fruits, the tree will always be there, the fruits will always be produced, and you can always eat those fruits. Same idea here. You take every dollar that you earn, after taxes of course, if you're salaried. As an entrepreneur, there's other things you can do, but as a salaried individual, you buy income producing assets and the income from those assets can pay for your luxuries. That is the best structure when it comes to focusing on assets, income, and doing that over and over and over again.